Let's get more on what to expect from the Fed tomorrow. Michael Schumacher is the head of macro strategy at Wells Fargo Securities. Michael, great to have you here on set. Welcome to the NASDAQ.
Thanks, Melissa. Great to be here.
So in terms of investors being long, from what I read in the notes, it seemed like you thought that maybe that was there wasn't much upside to go here in terms of what the Fed is going to give us.
It's interesting. Yeah, 75 is done. We don't have to talk about that anymore. Really, it's the tone. Is it 50 next time? Is it 75? Is it we don't know? And also, what does the Fed do longer term? This is what's getting lost, I think, in the whole discussion. How long is the Fed going to stay pat once it gets to whatever that terminal point is? Is it a few months, which is what the market price is? Is it 6 months? Is it a year? I think it might be 12 months, maybe longer. People are not set up for that. They're not thinking about that. But the problem is they won't believe Jay Powell tomorrow when he tells them. He's got to beat them over the head time and time again. One time, two times, not enough.
So you think he's going to be very hawkish tomorrow?
I think he'll try, but he won't succeed. And the reason is you've got Q&A. His best performance really was at Jackson Hole. What was that? 8 minutes, leave the stage, no time for coffee, I'm sorry. That was it. Drop the mic, I'm done. I'm going to go look at the Tetons or something. But he can't do that tomorrow. So he'll get quizzed. A lot of people ask tough questions. And he'll tend to hedge at some point. And I think that's the issue for the market. If people get just a whiff of an idea that, hey, maybe it's the last 75, and I can't believe we're talking about 50 like it's a non-event, but it would be a relief almost. I suspect the market's going to take that and kind of run with it. And you'll get a fairly short-term rally, let's say in risk and long-term treasuries, that kind of thing. It's really tough for Powell to get home that point. We're going to stay. He just can't really do it easily.
You mentioned, what happens after in terms of how long rates remain elevated. And if I said to you, Michael, we know that the Fed is going to keep rates where they are, plus 75 basis points, maybe plus, 125 for the next 6 months versus the next 12 months. Does that change your view on how you allocate a portfolio or how you recommend allocation?
It does. If you think the Fed is going to be on hold for 12 months, it makes bonds a lot less attractive, and it makes taking risk in general not terribly appealing. You think about those discount rates being a lot higher. The market's priced for something like 40 basis points of easing, give or take, in the second half of next year. If that's off the table, do you want to own as many equities? Probably not. Do you want to own long-term treasuries? I doubt it. Even the short stuff's not that great. So maybe the I bonds, they might work, but not a lot of other great alternatives in that scenario. So it's probably too soon to take risk in that case.
So, Michael, let me ask you, let's say they get to this terminal rate, and I would think that at that point they're very dependent on what the inflation environment is. Where does it have to be for them to finally turn around and ease?
Yeah, the Fed will focus on core CPI and core PCE. Right now, inflation's just high. It doesn't matter. But it's going to look at core more and more as time goes on, I think. And we've got core going down to about a 4% annualized rate early next year. So pretty good drop from its current level of 6+. And toward the end of the year, around 3%. That's probably getting toward the neighborhood that if the economic backdrop overall is really poor, the Fed might conceivably come into ease. But it's not quite there. So you've got to ask yourself, if inflation runs above 3, 3.5, would the Fed really contemplate an ease at all? I doubt it. But if it's 3 or 2.8, would it? Maybe. So it's that core number, and it's probably in the latter half of next year. Earliest case, I would suspect later.
How do you think about how a recession plays into this in terms of how the Fed, gives up hiking, maybe even cuts, and how that factors in for next year?
Yeah, this is why Jay Powell gets the big bucks, or at least is on the hot seat. He's going to get a tremendous amount of pressure, he and the whole committee. You can imagine a scenario, and this is what every client wants to talk about in some shape or form. Inflation's down, but still high. Unemployment's up. Maybe it's 4.5%, maybe it's 5%. Equities, not so good. What do you do if you're the Fed? One thing you do for sure is get a lot of pushback from Congress. And lots of people, it is, and it's going to intensify quite a bit. It's going to put the Fed in a really tough spot. So if unemployment does head up to 4.5% or 5%, does Jay Powell really hang in and fight inflation? It's an open question. I think he will want to. The rest of the committee, we're not sure.
Michael, good to see you. Thank you for coming by.
Thanks, Melissa. Pleasure.
Schumacher. All right, so Bonwin, how do you think about all that?
I think Michael raised a couple of good points. So in terms of reaching a terminal rate and then persisting there, I think that's really what's not priced in. Like we said, 75 is kind of off the table in terms of we already know that's all but a given. 50 at least the following month is all but a given. And then the economic conditions are also kind of the variable there. And I think it's presupposed that we're going to get to some terminal rate, have some massive erosion in underlying economic dynamics, and then be forced to pivot. But that may not happen. And a lot of the economic indicators that we're getting, in fact, whether it be JOLTS, whether it's construction, whether it's the last GDP reading, are still saying that things are holding up very well. So we might have a longer tail or top to that plateau than perhaps is suspected.
We talk about the pressure that's coming from Congress on the Fed. I mean, this is a group of legislators also that are like traders. They have not seen an environment where they haven't had the tailwind of monetary policy. And do your job, too. I mean, fiscal policy at many times is really not matched up. I'm not encouraging, because we've been watching this tug of war between fiscal and monetary over the last 3 weeks, especially in the UK. I just point that out. I think you get back to the sectors that perform in lower growth environments and yet can have pricing power inflation. It sounds boring, but healthcare and consumer staples are going to continue to work. I think energy will continue to work because there's nothing in this backdrop that I think deteriorates demand so badly when we're demand constrained around the world right now.